The Consumer Bankers Association is pleased to welcome you to today's webinar, Greater Profitability in 2025 and Beyond, Ingredients for Success, presented by Curanos. My name is Isabel and it is my pleasure to facilitate today's event. Thank you for joining. Please note we are recording and all participant lines are muted. If you have any trouble, please email conferences@consumerbankers.com or send a message in the Q&A box. This presentation will last up to 60 minutes and will include question and answer opportunities at the end. You may submit a question at any time by entering the questions into the Q&A box on the bottom of your screen. As a reminder, the views expressed in this webinar are those of the presenters and do not represent the views of CPA or its members. It is now my pleasure to introduce our speakers, Olivia Liu and Peter Gilchrist from Curanos. Welcome, guys.
Thank you so much, Isabella. Delighted to be here. Maybe we'll spend just a minute or two introducing Curanos for folks who haven't heard, and then let's dive right into the webinar. So, at Curanos, we specialize in collecting absolutely as much information we can about every single piece of the U.S. banking industry to provide our clients with opportunities to improve their growth, improve their efficiency, improve their effectiveness, whether that's in things like finding the right product, the right customer, the right price, or what have you. We do that largely for our clients, and then whenever we can, we step back and try to do it a little bit for the industry, which is the purpose of today's webinar, to try to look at where we are right now from a profitability lens and see, okay, what can we all do together to try to chart out the right course for improved profitability and improved valuations in 2025 and beyond. Olivia, other things you want to say to introduce Curanos?
Nope. I think that covers it. Yeah, our biggest value proposition is literally the amount of data that we have to really inform strategic decisions. So I think there's a lot we'll cover.
We promise that there is an optimistic part of this webinar. It is not the beginning. So let me dive right into slide 5 and take a look at where we are from a U.S. banking profitability standpoint, sitting here in the middle of the third quarter in 2024. Again, we will get to the rosy opportunities for path forward, but the position right now is that we're not in a great profitability spot, not as bad as we could be, but not a great spot in the third quarter of 2024. We've had year-over-year declines in net income, driven largely by interest expense, far outpacing interest income growth. If you look at the second column of our industry slide here on loan yield and cost of deposits, whether you're a bank above or below 100 billion in assets, there's a very significant difference between how the cost of deposits has been evolving year over year relative to the loan yield. And it's challenging to improve profitability in an environment where for banks under 100 billion, you're looking at a 28 basis point differential between increased deposit costs relative to increased loan yield, and a slightly worse 35 bip difference for banks over 100 billion. Obviously, it's been a period of profitability headwinds for the industry, and that's clearly shown as you can see from a return on tangible common equity, where it's outside of the largest financial institutions in the U.S., which play almost to a degree in a different market and a different scale game. It has been challenging to find our ROE growth in the environment of the last year, and that's been reflected certainly in what we've seen in stock prices for the U.S. banking industry. On top of that, there are some concerns that actually haven't really impacted profitability yet, but remain on the horizon relative to asset quality, which has been relatively benign despite lots of concerns about potential issues in CRE. We've seen, as I noted, quite a bit of NIM compression, which to a large extent you'd expect at the plateau of the interest rate cycle, and certainly quite a few things going on in the geopolitical scene that have the potential to impact U.S. financial services, and tightening lending, which is always going to make profitability tighter when we think about who and why and where we're willing to extend funds. But there also are quite a few reasons for why the second half of 2024 can be quite a bit better than where we've been. and that we can set ourselves up for 25 that has materially different, materially improved profitability outlook than what we've had so far in 2024. A couple that I'll start with on the lower right of this slide. So, I think there's reason to believe that that revenue growth can be maybe is advancing and hasn't fully hit the earnings reports yet, but can be further advancing in 24 through a closer connection to customers from U.S. financial institutions. Olivia will go through quite a bit of that as we get into the later slides. There are reasons to believe that things like AI as well as long-term IT investments are improving the operating leverage of the industry, not just for big four banks, but potentially for institutions across the size spectrum. And hopefully we're getting into a spot of greater macroeconomic clarity. Hopefully we're getting into a spot where we have a better sense as to, are we canceling the recession? Are we getting a little bit of a recession or what have you? And I think we learned a little bit from the Fed in terms of what to expect in terms of rate cuts, just earlier today. Now, if we flip over to the next slide, I think when we think about macroeconomic clarity, the biggest thing we tend to think about is where the Fed is from a rate standpoint, and it's now pretty clear, absent a change over the next handful of weeks, that we're going to get a rate cut, more likely than not in the 25 bip variety in September. I want to emphasize that just the clarity that is very likely to happen, we see as very helpful in terms of planning for where we're going. Maybe if not the speed of declining rates being clear, certainly that we're in that environment, that we're out of the plateau is very helpful. I think the biggest challenge we have in a declining rate environment is what can sometimes be the disconnect between bank investor expectations of benefits of a declining rate environment and reality. So when we are out talking to investors or talking publicly in the industry, we make sure to remind people what happens historically at the beginning of a rising rate, at the beginning of a declining rate cycle, and it is not an immediate 100% downward beta, which sometimes seems to get mysteriously assumed by investors. So I think there is a very significant education piece that we're certainly playing a part of, and I think everyone needs to play a part of, to remind people involved in the industry that even though Fed rates are coming down, that doesn't mean miraculously that we print money and that we've got perfect one-for-one decrease in deposit costs. There's a lot of math behind that, a lot of underlying reasons why we don't get immediate benefits. Some of them are laid out on this slide. The first thing I'd call out is just you look at consumer CDs. We've got a heck of a lot more CDs as an industry now than we've had in recent time, and those are expensive, but they're not universally top of market. And when we think about what's happened in prior falling rate environments, it's often the case that CDs become actually more costly to banks in the early innings. It's hard to know at this point whether that beta is likely to be positive or negative, but it's certainly possible that the consumer CD beta is negative, i.e. that the cost of consumer CDs continues to go up, even in an environment where the Fed rate is coming down. The math behind that would be that, sure, the poster rate is declining, but there's continued remixing as you've got more maturities coming due. There are also quite a few dynamics in the commercial deposit portfolio, with still pretty big chunk, $1 and $6 of commercial MMDA deposits are still under 300 basis points. It's hard to see how you're going to get a very significant downward beta on all of those dollars when quite a few are still priced underneath 3%. And then, of course, as we have in every declining rate environment, we're in a spot where you've got quite a few non-interest bearing deposits that are in the system, and that would still potentially have access to higher rates, even in a lower rate environment. So knowing that there's clarity that rates are coming down, super helpful, knowing that we're going into a declining rate environment and that we're executing, hopefully already executing our planning for what we're doing in a declining rate environment, super helpful. And the more that we can do to educate the market and set expectations that there are interest expense savings, but they are not one for one relative to Fed rate cuts, will be very helpful to industry profitability, and certainly something that we're focused on when we're making public remarks. The other item on the next slide that I'd raise in terms of immediate challenges is that lending remains subdued. There are reasons to believe that elements of lending can pick up in a lower Fed environment. Whether those pick up the day after the FOMC meeting, I'd be surprised. You're seeing still a relatively stagnating mortgage market, for example. There are green shoots. There are signs of life that can pick up. That's according to our models, more likely to be a gradual increase than a sudden increase. And typically the macroeconomic data that leads to a falling rate environment is unlikely to lead to massive CRE or C&I loan growth, certainly out of the gate. So we're likely to be continuing in this position where lending volumes remain relatively subdued, both because of the cyclical aspects of our macroeconomic situation, as well as continued competition from non-banks. We'll get into this a little bit more when we talk about the regulatory angles. There may be some reasons to believe that there's going to be relatively more pressure on some of the non-bank competitors over the next series of years, which could be a net positive for the banking industry. But ultimately, that has been a detriment to bank loan growth over the last several quarters and years. Olivia, do you want to pick up on the fun world of consumer fees, overdrafts, and
Perfect. Given all the different macroeconomic factors already that P kind of walked through, one other big factor that's under pressure is really around non-interest revenue. And so elimination is probably too strong of a word, but certainly a very vast decline in overdraft and NSF fees from the consumer space. And we kind of drew out what are the major, I would say, forms of fee revenue hitting everyone's books on a trended basis, just to give a sense that although we're seeing slight growth in other streams of non-interest revenue, the amount that the industry is seeing from a decline from an OD NSF perspective in the consumer space is quite drastic, and much of it is around how do we think about driving up fee revenue, and on that related to servicing, we'll talk about what are some of the opportunities from product as well as a servicing perspective in a bit when it comes to shifting demands from different segments. But this certainly, in addition to, I would say, all the different headwinds that we kind of walk through from an interest perspective, this certainly brings additional pressure to everyone from a P&L perspective. So on the next slide then, so slight kind of shift in terms of thinking the other big dynamics, right, even beyond the macroeconomic factors then, are really the shifts in consumer and business demand. And so on most of the chart here, on most of the slide here, you see a couple of big bullet points in terms of what is happening with the consumer, and I would say also business preferences as a whole. First of all, when we take a look all the way to the left from a even purely just opening channel perspective, the role of digital account opening or online opening, DAO and OAO, we can see that there's a much higher preference. A vast majority of consumers and businesses really prefer to open via a digital channel. However, and I'm sure most of the folks on this line have seen the numbers in terms of what the difference is, though, of those who actually open via your branch, so in person versus your digital channel as a whole. There's a vast difference in quality. And so not only from a balance perspective, as you can see in the middle chart, It's about 7x difference within the first month. It starts creeping back up a little bit, but still about a 3x difference, right? By the time you get to 6 months in to that initial kind of new to bank account. But on top of that, you start seeing the retention, actually, the retention gap on that third chart actually that gap is quite large between a digitally open versus a branch open account. And this already, and at this point, the gap was actually much larger a year and a half, 2 years ago, when fraud was at really rampant. At this point, there are a good number of controls already across the industry where we're actually, it's not to say that's not a problem, where we're seeing the gap close a bit, but still furthermore, we tend to see much larger digital preferences as a whole. And I would say on top of that, given all the high rate environments, or the higher rate environment that Pete had just walked through, we're also seeing on the commercial side, and we're starting to see it kind of pick up in the business banking side of things and wealth, is that there are more balances that are really hitting interest bearing accounts as opposed to non-interest bearing accounts. And so there is a shift there, and hence your portfolio rate paid is likely heating up quite a bit across consumer, wealth, and commercial, with small business really the lagging segment there in terms of heating up in cost of deposits. Pete, anything you want to add on this front?
No, other than just in the interest of having some optimism, I think your comment on how well the industry is starting to do on digitally open accounts is a really important one. And I think if we'd gone back 1, 2, and 5 years on the third column chart here of account retention by channel, I think it's really impressive that the industry hasn't solved the problem yet, but we're making headway on it. And I think that is a significant bright spot that as an industry, we get it. We figured out not all of the things, but we're chipping away at the problem, and we're setting ourselves up for future profitability success by coming closer and closer to bringing digital to be something that looks like the historical branch open account. And the more of those different metrics that we're getting better and better at as an industry, the better spot that we're going to be.
I like that line of optimism. It's good. It's on the, I would say, kind of moving forward, then given the shifts in demand as well, right? This starts introducing different sources of competition. And so this is across the board, whether it's within consumer, within wealth, business banking, as well as commercial. We're starting to see other non-traditional players really enter the space. So I think a lot of folks know, especially from a consumer perspective, a lot of the fintechs, a lot of the digital only players like a Chime, et cetera, are really starting to take share in terms of primary bank acquisition. Bear in mind a bit more on the mass market end of things, but a lot of the direct institutions like Ally, et cetera, are really starting to pick up from a more affluent base perspective. And we start seeing that too as well, really within the small business space, as you can tell, and as we start heading toward the right, as where more non-bank institutions are actually gaining good levels of awareness within the space, and also are garnering not primary relationships yet, but more so secondary relationships. And so we're really seeing a fragmentation of wallet, if you will, and value on a per customer basis that's really occurring within the space. And certainly within commercial banking, right, we do see a good amount of private credit market pickup, as you can tell from the growth rate overall. And so that's also another stream of kind of fragmentation that's really happening, where non-traditional institutions are really coming in and taking share of these relationships. And this really hits home then, because when we look at it, whether it's within the mass consumer space, the affluent space, the business banking space, when we look at the average typical number of institutions or number of products and accounts within their wallet as a whole, we are seeing that number pop up. And it's not to say that, right? It's not to say that every relationship within each of their wallets are creating created equal. There's likely one primary relationship, but we're seeing though that means the fragmentation of the wallet is really coming to fruition in terms of the value you get from on a per relationship basis, maybe getting eroded over time as well as competition picks up. And on top of that, on the right hand side, as a good kind of indicator, what we're seeing on the consumer end is that we do see the cost to acquire also pick up quite a bit. And so this is the previous rate cycle or pre-pandemic perspective at from a new to bank customer acquisition, it was around $300, and this is fully inclusive, right, of brand and incentive, where we see about 140% increase, I would say, up to $700. And so we think about the dynamics of if it costs a bit more to actually acquire the customer overall, but we're also seeing fragmentation of the wallet on the other end because of shifting consumer demands and shifting business demands. There is a larger question of how do we think about go to market then in a more optimal and right-sized way. And then on the back end, from a portfolio perspective, how do we really think about a more effectively deepening and onboarding clients that we're able to attract and actually open an account with us.
I think the other thing that really comes across in this data, Olivia, is that we can no longer count on getting every single piece of a client relationship because we got the checking account, and in a sense that's a challenge for the industry, because we can't assume that we're going to have every single piece of the profitability that a client can generate. On the other hand, it also creates, I think, a more significant opportunity for us to find new clients if we're really good at a piece of the relationship. So, if I am a relatively more modestly sized institution with a relatively more modest IT budget, I can be good at specific pieces of consumer or small business or mass affluent or commercial service, and I still have a chance because increasingly people are willing to have multiple primary accounts. They're willing to say, okay, for this thing that is really important to me, I am willing to have a separate relationship, or maybe it's two things, or maybe it's three things. Yes, it pushes the industry to be good at as many things as possible, and you don't, we can no longer get away with being so-so at a whole bunch of stuff, and people will just do have those products, do those services with us because we're their primary institution. And the other side, it makes it easier to enter and to excel in a specific area, and that may in the long run be good for the industry and be good for the industry's customers if we can be in that position where we actually get better service, more product innovation, and kind of a more consistent profitability value exchange between our institutions and their clients.
Which is a perfect segue into the next kind of set of insights here. And it's not to say primacy is completely dead, right? And part of this is that primacy it is still extremely valuable, but the definition of primacy may be very different depending on which consumer or which type of business you're talking to or trying to attract. And so when we look at it from a customer economics perspective versus a commercial perspective, we still see the primary customer being a much higher source of not only non-interest income, but very stable deposits, and certainly much lower cost from a deposit perspective. And so from that tells us that there's still a lot of value there. The question around primacy is that as the more we see in the industry and the more I would say the more digitized we are, the more products and services need to really catch up from a digital experience perspective. This starts then really siphoning and segmenting different consumers and businesses into their own, I would say, versions and segments of different definitions of primacy. And so it is pushing really institutions within different institutions to rethink how to identify primacy and primacy potential, and what to actually do about that in order to drive the types of economics that you see on this particular slide. The only other thing we'll point out here from a more macro perspective too, is also leveraging machine learning and AI as a whole. Of course, any sort of forward-looking deck shouldn't exclude AI, but a part of this is at least providing a perspective of what AI can do in this space. So something on the left here, this is one of the things that a lot of institutions will tell us is that, you know, your front line, your people are the absolute you know, core of any sort of relationship with your customer, which is undoubtedly, I am sure, very true. The one question is, how do you translate that though into an experience, into, I would say, a future-proofed experience where you're able to translate that in-person experience not only to digital, but to every single touch point that you make with that particular customer and client. And what's interesting is that we had some hypotheses, and you'll see this, you know, this web of a chart on the left-hand side, where we thought maybe there are 20 journeys across the board for any customer, any client, where it probably gets them toward a primary, you know, become a primary relationship. And what was interesting coming out of the study was that actually there are not 20. There are actually thousands and thousands of these different journeys, and they all travel in different ways to actually get to a point of primacy or higher value customer relationships. And so given that there isn't an ability to necessarily manually A/B test every single touch point, every single right, every single point of every single touch point, every single digital digital decision or underwriting decision, etc. And so there is likely a place where we can you leverage machine learning and AI to really think about how to drive first kind of some applications, whether it's within customer servicing, very simplified, kind of simple customer decisions servicing, all the way to kind of marketing personalization. So what are the major touch points with existing customers, to pricing automation, really thinking through, you know, taking into account pricing elasticity and scores, and how pricing could be leveraged, and how leverage and actually put in front of the customer overall, all the way to, I would say, much more complex decisioning, such as advice overall, more holistic financial wellness advice, all the way to a very much a one-on-one kind of personalized experience perspective. And of course, underneath all this, there's of course an opportunity to think about AI operationally, whether it be, you know, on the back end, simplifying documentation, interpreting documentation overall. But from a customer-facing perspective, there are many applications here that we think there's a larger opportunity to leverage AI.
Yeah, and what you're showing here, Olivia, on the right-hand side is consumer and small business. I think that's indicative of the primary applications of AI in U.S. financial services to date. I think there is still a pretty big open question as to why, you know, the broader, you know, commercial, you know, treasury management system environment hasn't seen a little bit more in the realm of AI investment. There's, I think, a lot of promise there, and a lot of untapped potential. At the moment, probably more is happening inside consumer and small business, and that's probably more aligned to our audience today. But I think also pretty significant opportunity in different depths of commercial, where the general mantra is to do things the same way that your great grandfather did. It's probably some opportunities for continued advancement there. But maybe if we keep going and kind of think about the broader externalities here, we talked about at the beginning perhaps a clearer macroeconomic vision. So we can stay on 14 for a minute, I think. We've got, I think, a clearer macroeconomic vision, if not crystal clear. I'd argue that we don't necessarily have a clear regulatory environment vision at this stage. I think there's increasingly a view that no matter what happens in November, that there are elements that are going to get tighter about the regulatory environment. That can be a positive or a negative for relative traditional institutions, because we don't necessarily know yet which elements of the system are going to get tighter. So it could well be that non-bank players, for example, that we start to see more regulation on non-bank lenders, more regulation on some players in the industry that don't have banking licenses, but behave a little bit like banks. So I think there's likely more that's continuing to to affect the profitability of the U.S. banking system, but that may be outweighed by bigger regulatory influences on areas that are a little bit outside traditional U.S. banking. I think we are seeing from across the political spectrum an agreement that the bank consolidation is not as unthinkable as maybe we felt like it was for a couple of years. We're seeing, I think, an opening, maybe not in the largest bank M&A activity, but certainly in the layer underneath that. All indications are that will continue into 25 and beyond, both in terms of official bank and credit union M&A, as well as increasing partnerships and from institutions that don't compete. So I think it's not just formal M&A activity, but also opportunities for like-minded institutions to collaborate when they're not in competitive areas, whether that's through organizations like the CBA or the like, or other mechanisms that are well short of M&A. And then, lastly, open banking has meant more outside of the U.S. than inside of the U.S. So far, and I think people often see open banking as more of a challenge than an opportunity for inclusion inside the U.S. I think there's also quite a bit to be said for the potential for open banking to improve some of the underlying and very significant data costs associated with U.S. banking today. It probably gets more challenging before it gets easier, and maybe we will be able to thank other countries that have done this first and maybe ironed out some of the kinks and challenges in it. But as I kind of think about maybe not 2025, but 26 and beyond, perhaps the potential benefits of open banking coming to the U.S. start to outweigh the costs. So with that, I think we'd like to turn to what we see as the 5 most critical strategic imperatives for banks, and with each of these, I'm going to continue my newfound optimism role and talk about why banks are well positioned to succeed at these strategic imperatives. So I think the first, whenever you're coming into a falling rate environment, how well you manage funding is going to be a critical driver, if not the most critical driver, to success, and something that needs incredible precision. And my optimism point through here is that banks now have better data, better analytics, and better optimization than they've ever had before in any interest rate cycle. And that should position them well. The investments that banks have made in thinking about their funding, thinking about the kind of granular segmented aspects by line of business and product and need, and being increasingly able to think about funding that comes from one person, why it's coming, and what's likely to happen to it. We're in a much better spot in an industry to be able to project that forward and to manage funding costs and volumes in ways that were really impossible 10 and 20 years ago. So it's the most critical strategic imperative, but one that I think banks are very well suited for. And I think that's the same on primary customer growth. The vision for primacy certainly has been perhaps the key strategic imperative for banking, certainly for all 3 decades of my career, and probably for many decades. But before that, we're not, as an industry, starting from scratch. We know how to get more and more granular on achieving customer primacy, on developing the information, the analytics needed to sell a first product, which is now increasingly more possible, and then to broaden that relationship profitably across a whole set of products and services that we're uniquely suited to provide an individual client. So it's critical, and again, we know how to do it. And on the third point here, we're not exactly in the first inning of AI either. We're maybe in one of the early innings of AI being on everyone's headline sheet. but banks have been implementing different types of machine learning also for 10 and 20 years. It's cheaper, it's easier, and we've got clearer potential in it. But we're by no means starting from scratch, and that allows us, I think, to do a much better job of figuring out where the right areas are for investments in AI. Where can it help? Not all of this needs to be green fields of sticking AI on a whole set of problems and figuring out which ones it can solve. As an industry, we know which ones it can solve, and we can put our investment dollars there. And the fourth one here, non-interest revenue growth. Olivia spent quite a bit of time talking about okay, well, we've got a different mechanism in place now to think about overdrafts and NSFs. Well, overdrafts and NSFs haven't been as significant of a driver of banking forever. We know how to win at this game as well. We know how to win as an industry at finding the proper value exchange for treasury management services on commercial and for the money movement services that we provide through a consumer checking account. We have to do it differently, but we know how to do it differently, and we're going to be able to figure out as an industry how to do it profitably. Again, just with slightly different rules. And then lastly, when we showed the slide on digital experiences and what it means to acquire customers digitally and how their behavior looks relative to a branch acquisition, yes, it's not an amazing spot today, but it's in a heck of a lot better spot than it was 1, 2, or 5 years ago. So it's both the technology that we know and trust now. Fraud isn't at the levels that we like, but it's not at the catastrophic levels that it was for a while either. And we figured out how to adapt a lot of the things that we've been excellent at as an industry in terms of bringing clients on board in a branch now to a digital format, and we're closer to having what we know as a playbook. So again critical, but as an industry, we've made quite a few strides over the last couple of years that I think set us up for significant improvements to profitability on that as well. Olivia, do you want to take some of these?
Yeah.
What it means for our different business personas?
Yeah, definitely. So we want to translate what those 5 kind of big priorities might look like then for each of the different lines of businesses and areas. So within the consumer personal banking space, number one thing, especially within the declining rate environment, how do you navigate that? What is your pricing strategy through it? How do we think about outperforming within the declining rate environment? That is likely the very extreme imminent aspect of what, top of mind, top priority as we go through, especially the next 6 months, 6 to 8 months. The second aspect here is around if it costs more to actually bring a new to bank consumer in as we can, and on the other end, it's going to, we're not seeing as much revenue actually come through. There's a much broader question of segmentation. Who do we actually go after? Who do we actually want to attract to come through the door? And what is a value proposition and product that we need to put in front of them in order to drive a good level of acquisition, but then also retention and deepening on the other end. And last but not least, there is likely a right sizing of market level investment. So evaluating then, given all of these different dynamics happening in the marketplace, evaluating your footprint at a market level. What is the right lever or right level of investment within your distribution, your sales force, your product, your marketing, to really have it all come together to get a sense of how you optimize not only within a segment, but really across your entire footprint and looking at it from a marketing or from a market level view. From a small business banking perspective, actually quite similar, right? Especially when we think about the pricing lever as a whole. The first piece here is that despite the it being small business still being the lowest, largest pool of low cost deposits at this point, there is a much, we're starting to see rate sensitivity go up and pick up a little bit. And so it is a matter of how do we think about pricing and leveraging interest-bearing deposits within the space to actually deepen and retain relationships within the small business space. There's also a larger question that really combines 2 and 3 together. No one has quite figured out small business yet, right? Small business had always been either, within the retail space or within the commercial space. But now that there's a more honed in focus on it, there is a larger question of what is your value proposition? What do you actually stand for in this space? What are your products? And then what is your actual engagement model that would make sense and right-sized it for the types of relationships that you see coming through, especially with the smaller micro businesses that you would expect. Pete, do you want to cover wealth?
Sure. Yeah. On the wealth side, probably first and foremost is thinking about controlling cost of funds in this environment. So we're continuing to see some increases in how in how our portfolio cost of deposits looks in wealth. I don't think those are really driven by the headline sweep lawsuits you see out there. I think they're driven by other factors, but just we've got pretty high Fed rate. We've still got pretty attractive cost of funds of wealth deposits, and so there's probably a decent amount of continued give back. Despite the falling rate cycle, wealth deposits, interestingly, have really become the latest ground for exception pricing over the last 1 to 1.5 years. So we, as an industry, we know well how to manage exception pricing, but we haven't historically done it to this magnitude in wealth before. So I think first and foremost, it's thinking about how we handle that changing dynamic of wealth deposits and bring the portfolio cost deposits and wealth back, maybe not to historic levels, but certainly closer to the profitability driver that it's been in the past. We certainly see there being an opportunity for a next gen value proposition in wealth, and part of that is the wealth exchange and who controls the wealth, changing generations. So high net worth individuals are increasingly being born later and later, and people who control those wealth segments are coming from different generations now and will continue to come from different generations. That's changing faster than our value proposition. Is changing inside wealth. I think, Olivia, is probably an understatement. The speed of change there rivals commercial at times. So our ability to come up with something that is new and modern and speaks to our actual customer base could be seen as a positive, I think, for our wealth clients. And that kind of comes along with a third point here in terms of future-proofing the operating model. Future-proof kind of implies that we're on the doorstep. This is one I think maybe perhaps we're not exactly on the doorstep of. I think this is an area that we've allowed to linger in terms of how we have prioritized thinking the way our clients think about wealth as a line of business. And then lastly, perhaps a little bit out of scope for this audience, but on the commercial banking side, first critical priority is figuring out how to drive value. So more so, I think even than consumer, the notion that having the primary operating account doesn't necessarily guarantee that I've got all of the operating items. Means we've got to think a little bit differently about what primacy is and why it looks like that. We're seeing not the same tidal wave of implications coming out of Silicon Valley that we saw in 2023, but it certainly has changed the average number of primary institutions that a client deals with. It hasn't removed the ability for modestly sized banks to serve relatively large companies, but it's changed perhaps how they serve them. and commercial banking as an industry has gotten a heck of a lot better on thinking that data and analytics might be able to provide some value for how they think about addressing their clients' needs. But we're still at best middle innings, and in that there's quite a bit of opportunity. In some cases, not just AI, but just just having data and analytics that are believed and used to guide decisions, even if they're calculator based. And over time, I think that starts to, for a lot of banks, reposition their the commercial book from from something that is book that happened to them to a book that is really logical for who they are as a bank to their commercial clients. So moving from wanting to and being everything for everyone to having a reason for a set of companies to look at an individual institution as their primary home. I think that way of thinking is been inherent in all the other bank lines of business, and I think we're finally getting closer to being there inside commercial.
All right. I think we have about little under 15 minutes left, but any questions? We might have a Shire group on a Thursday.
Yeah, Olivia, there is a question
yes,
here. Yeah, on CD on CD renewal rates, and it may be easier for us to follow up offline with a sheet of pages, but I'll offer a couple high level comments on CD renewals. I'll probably keep them to comments on consumer CD renewals. But generally speaking, what we see for CD renewals, the number one factor for whether a CD renews is whether it's renewed in the past. The number two factor is tends to be the rate, whether the rate is of the same competitiveness as the rate that the client came in at. And then I think increasingly, third, Olivia, I would say is the messaging that we chose to deliver or not deliver to encourage that CD renewal, or to not say anything about the CD renewal. I think that's how we broadly think about the the impacts of what's driving renewals on the CD side. What we've seen from a data standpoint is largely in line with prior cycles and with those three variables. That roughly speaking, if you segment the books based on number of prior renewals and what we were willing to put out there in terms of our rate, we get to roughly the CD renewal rates that we would have expected in this cycle. One of the slides I often like to present, but that we didn't show today, is people often expect CD renewal rates to change a lot cycle to cycle, because they say, well, isn't the audience changing? Don't young people not really get interested in CDs? And the only reason they're interested in CDs is because there's some enormous rate. And while clearly there's quite a bit of rate shopping in the CD space, and a lot of the hottest rate money winds up in CDs, interestingly, the notion that CD as a product is dying and that younger generations are not interested in it turns out just to be false. And we're as guilty as everyone else of sometimes falling into that trap of believing that, okay, this generation of young people won't like CDs, even though all the other ones did. And when you actually segment it, it's just that every time we do it, the youngest generation's broke. And so you're not interested in a CD if you don't have any money to put in a CD. If you got money, you're interested in CDs. And there just isn't a statistical difference in terms of age being a critical factor. It's just that if you're broke, the first thing you're going to do is probably not go go into your local branch and open up a certificate of deposit. And then Olivia, it looks.
Let me
Go
take the
ahead.
next one from
Yeah.
an open banking perspective. And this is really in reference to 1033 within the US, but open banking at the core of it is really around data sharing and regulations around what data sharing could look like, especially to third parties outside of your bank. And so outside of your wall overall. And it may mean, and again, it's implemented a little differently depending on which country, et cetera. But it does enable basically for you to share information and for you to get information from other institutions to get a sense of not only financial picture, financial profile, but financial wellness as a whole. And it can cover a range of whether it's from balances to product ownership to engagement types of behaviors. And again, there you see glimpses of this already a little bit, like when we think about like a Plaid, for example, right, as a type of facilitator. But if we do go into more 1033 types of rules, and as we see the CFPB come out with what the definition is, there may be a lot of there will be, I should say, more implications on the data front, the API infrastructure front, and then how you actually design then products and digital experiences given the level of data you may be able to share as well as intake. And so can definitely follow up separately on that front, but certainly a big topic that we can dive deeper into, but then also actually get some clues in terms of what happens from outside the US.
Olivia, let me take this question that I'd summarize as, hey, does it make sense to consider the book of deposits between consumer, kind of implied mass affluent, and also wealth, all under one umbrella? Given that a lot of times the value prop that we're offering to the client looks pretty similar, and so I guess. Olivia, the way I'd start on that is if your value proposition truly is similar across those segments, it may well make sense to combine the treatment of those three deposit classes. Generally, I think there's more similarity between the value proposition to a consumer customer and a mass affluent customer than there is between mass affluent and wealth. So, when I look at the world, when we really get into wealth, I think about the deposit as being placed by an advisor. And so when I'm sitting in a banker mindset, when I look at wealth deposits, I think about those not actually being driven by clients, but being driven by the client's financial advisors. And that in and of itself creates a very different dynamic for what the deposits are, how long they can stay, how they can be priced, how much the client even knows that they exist. So when you've got that different of a value proposition and that different of a servicing mechanism, I think it's very important to separate out how you manage them. Now, Olivia, maybe I'll leave the mass affluent consumer question to you, because again, if you're running similar value propositions, I don't know if that's always going to be, Olivia, your advice. But if you take that as a prerequisite, maybe it does make some sense to think about deposits as a group.
Yeah, that completely makes sense, right? When you think about all the way probably up to premier, would make sense. So like the emerging affluent all the way to kind of mass affluent, maybe a little higher. But in terms of grouping them together, the value proposition are likely going to be a little different, and how you interpret the proof points underneath those value propositions are going to be different. But if you're able to show a really nice spectrum of graduation really across the suite, that's really the biggest piece there, is actually to inspire and give folks a sense of what a journey could look like with you. And hence, like exactly what Pete is saying, it makes sense to actually house and think about the deposit journey from mass market all the way through, or entry level all the way through that, probably that premier space. The wealth space starts becoming a different type of animal, and certainly more service oriented.
Olivia, there's a really fun question about why we're so fixated on redefining primacy when we've had a definition forever. And I really like that question because like there's a piece of me that would love not to. I stuck redefining it in commercial because I think it's less clear that the inflows, basically if you define primacy based on where the primary inflows and outflows come, that's great. The question is whether they're going to keep coming from there, and whether our clients see it the same way. And I think one of the most interesting dichotomies that's opened up is the distinction between our banking definition of primacy and what a client thinks is their primary financial institution. And so I guess what worries me about not redefining our definition is that I worry that if we keep going with what we've always said is primary, but more and more people think that some other institution is their primary financial institution, even if, frankly, they're wrong, that isn't necessarily setting us up well to react to the next generation of banking customers. It worries me that causes us to behave in a way that's inconsistent with how our clients think of us. But Olivia, that's probably more your cup of tea than mine.
Oh, I echo that sentiment overall. And if in simplifying it to maybe just I think even the share, I think the question around the hypothesis of whether or not it should just be share of wallet, could actually be share of wallet. It should translate to that. And the larger question is, how do you tap into a primary perception? So like the perception that you are their primary institution, so that you can get the rest of their relationship, or a good portion of their relationship, and that you're top of mind for any future financial money needs. That's a piece where if we stick with the existing definition, we're not going to actually see our value propositions really flow through. And so if we can hone in on how individuals or how segments actually define their primary institution, and it is quite different depending on who you are and along that spectrum, then you can start designing products and marketing messaging in a way that actually hits very close to where they would want their FI or their bank to be. And hence that's really a big driver behind how you could drive acquisition, but then on the other end, how you can actually drive deeper relationships if you can hone in on what their definition of privacy might be.
And maybe it's really a near-term, long-term differential, Olivia, in the sense that, like, if I've got 90% of share of wallet right now, that's going to be great for me in the near term. But if I've got 90% of somebody's wallet share and they don't, and I'm not top of mind for their next banking product, their next financial product, that's an indication that, like, it's not going to work for me over the long term. And so I might be in presumably a really good spot, but if for whatever reason they think, Venmo is their primary financial institution, then I'm not going to really have this long-term customer journey.
Yep. I know we have a minute left, and this last question here around onboarding gap. It's a little bit of both. I think the issue is that a lot of digital journeys have been designed based on your in-person journey. So basically taking your in-person or in-branch experience and then putting it right on top onto digital rails. And that's just not how people actually interact from a digital perspective. And what's interesting is that we saw the gap earlier, 7x within the first month, about 3x by 6 months. If you look at other more digitally mature industries or economies outside the US, like the UK, for example, that 7x gap initially actually comes down to about 2 to 3x. So the gap actually closes quite a bit if you're able to drive a good amount of digital personalized, I would say, digital journey, especially within the onboarding aspect. That so it there's that I would offer up that. All right. I know we are at time, but I've oh, Isabella, go ahead. I'm gonna hand it back off to you.
Did you guys want to do any closing remarks and then I'll hop in?
I don't think so. I mean, we, our contact information is coming out in the open, so be happy to provide that as well. Actually, we can provide that in the chat just in case. Or Isabella, if you can provide that to folks on here, that'd be awesome. Feel free to reach out with any questions. But yeah, I'll hand it back off to you.
Follow up later today or most likely tomorrow morning with all of the registrants for this webinar with your contact info as well as a replay of the webinar. So again, thank you so much, Pete and Olivia. Really appreciate you guys coming back here and talking to our members. The session has been recorded and it will be available within 1 to 2 business days on our website. And you'll also, as I said, get the recording in your email. On behalf of CPA, thank you again to our speakers and everyone who joined us today. Have a great afternoon and you may now disconnect.
Thank you.